Sorry, I clicked on go live. Oh, it's live. Okay. Hi, Amy. Welcome to Winter with Grace.
Hi, Grace. How are you?
I'm good. You're such a legendary icon person in the finance space. I'm like just so thrilled to like have you here.
You're
um,
so sweet. Thank you.
so let's like dig deeper into like your early so I want to start for like the audience who don't know you. Obviously, like I think like we couldn't ignore the fact that you were the CEO of Barclays Stockbrokers, and like why don't we start with like early on in your career, that kind of like what are some experiences that shape you into who you are today? I know that you went to Africa early on in your career, and then when you got there, it was kind of like chaos, and then you joined. Okay, I'll let you finish the story and like maybe some like key takeaways there.
I guess that, well, we're going to go way back. Yeah, so I was doing a junior year abroad in Cameroon, Western Central Africa, and I had gone there because I was international affairs international affairs major, and I was studying sub-Saharan Africa as my concentration. And I think up until that point, I always anticipated a life in the State Department or in the kind of foreign service of sorts. And I think having had that experience, which by the way was life-changing, game-changing on so many different levels, but also was a sort of a really great moment of acknowledging, that a young 20-something woman living on her own in Central Africa, working for the Peace Corps, trying to sort of, piece together what I thought was going to be my future. I didn't come from anything and anywhere. And I really had this sort of core instinct that my desire to do good and to be good in the world and to create value that matters. There just was something about going into government service that sort of freaked me out. I think I just thought, oh, I don't know if it's my personality or I started to see how the world worked. And once I saw how the world worked, I realized, well, it's not going to happen if I'm backpacking around sub-Saharan Africa trying to make a change. And so that was sort of what led me kind of randomly into finance. I came back to my undergraduate school, Dickinson College, and I went to the career office and I said, I think I need to go work on Wall Street. And they laughed at me, first of all, because I had no no classes that would suggest I was a potential business major. And I just kind of, set my sights on figuring out how do I get to where things happen, right? Where the money is where things happen in this world today and probably always. And I knew that if I brought my sort of clear-minded intentions and my values into a place that maybe didn't necessarily welcome them, I'd find a path to doing some of the same work at a very different level. And so I started, and I actually think part of the reason why I was recruited, in fact, and this is probably a theme through my life, I'm certain that part of the reason why I was recruited with no experience at all had a lot to do with the fact that I had a great story to tell about doing something that no one else had done. And I think, when I joined in my first job in Wall Street was an investment bank, and I was very quickly in the sort of, analyst training program, and you do this and you do that, and then if you do that, then you go to business school, and then if you go to business school, then you get this job. And it really felt kind of wrong to me, right? It felt like I didn't feel comfortable just being like everybody else. And so that was actually what led me eventually to financial technology, right? This idea that like there was something happening, and this was the mid-90s, where it was clear that the sort of old way of doing things in financial services wasn't probably going to last, and that the elements of what was happening in the internet boom in the kind of late 90s, early 2000 would have an impact on the markets, but also it kind of led me down a path where I started to pick up projects inside of these big banks and these big brokerage firms because I was interested in something that nobody else was interested in, right? I wasn't interested in being a baby banker. I wasn't interested in doing an M&A portfolio. And that's sort of what led me down the path that eventually landed me at Anthemis.
I wanted to learn more about like, okay, so if you're starting out your career, not starting out, let's say like if you have some experience and then like in today's age, like what would you identify as like the equivalent opportunity as as what you did back then, like,
Yeah,
women
you
in
know,
finance, that kind of thing.
I just read something this weekend that really gave me a lot of hope. I've been obviously, as a technology investor, deeply, deeply concerned about some of the trends in AI and where this could lead us if we're not careful. And I read something this weekend that was really hopeful. It suggested that the sort of education that one can find inside of the liberal arts was going to be the saving grace for a lot of our AI programming. And that made me, and I get that, right? Because as a product of a liberal arts degree and a liberal arts education, the ability to think critically, the ability to communicate, the ability to see around corners in a way that isn't always logical, much of it is instinctual, is going to be the thing that will matter as we're
Mhm.
programming these large language models. And so I guess when I think to kind of, younger people starting out now, question as to whether or not we will be within the next 10 years sending all of our children to college. I don't know. But I do think that if you have an opportunity to pursue higher education, I would encourage um, leaning into the arts, leaning into liberal art thinking, leaning into the humanities, and remembering kind of how we all got here.
Mhm.
And and sort of looking to craft. If your interest is in financial services or your interest is in technology, to me, for like we're constantly when we hire, we're looking for people that do not look like everybody else. The business major, dime a dozen. The computer science major, dime a dozen. Not to say that there isn't great opportunities there, but to me, we need people who can think and who can challenge um, and who can consider, which I don't think there's a lot of consideration these days.
Totally. I wonder, okay, so what about so like, okay, there's like two parts of my question. One
Mhm.
part is like, since you're like very successful in today, like what would you say would be the path that you would take in today's age? Would it be joining like an AI company immediately, or like would it be like starting your own fund focusing on AI?
Yeah.
Would it be like
Well,
you know,
with the goal, well, I guess it depends on what the ultimate goal is, right? Is the goal, career advice for venture capital for people who want to be in venture capital
uh
specifically, or kind
yes,
of
because I
career
feel like
advice?
you're running a really huge fund as a female founder and
Right,
CEO
right.
of a huge fund,
Mhm.
and you have like a really great success in the financial industry. And like, when I saw you're like you're on the board of trustee of your own college, like that's like such a goal. And I wonder, to achieve this kind of level of success, like what would you say would be like three core things that contribute to your success?
Well, I think taking nothing for granted is probably a starting point, right? I mean, it is, a lot of us who have achieved, quote unquote, achieved so much can often make it look like it's really easy. It's not. The amount of hard work that goes into building your own company, being an entrepreneur, um, creating a community that is, in our case, inclusive and welcoming to others, um, is not. It's not just about. It's hard work, but it's also oftentimes incredibly lonely, right? So surrounding yourself with people, whether it's people that you hire, people that you work with, people that you choose to go into business with, that can fuel you up and make you feel so not alone. I think that's a big part of it because there are days that are really tough, particularly if you're doing things like we are at Anthemis that are going against the grain and against the status quo. There are going to be times when you feel very, very alone and like you're the only, even if there's 30 of us, 50 of us, 70 of us, that we're the only ones thinking about this. And right now is one of those times, right? When like this, the idea that you can build an inclusive team, that you can, put capital to work to serve the better good. Like those are ideas that are not so popular right now. and so you have to, I think, appreciate that, don't don't take anything for granted. Hard work, and surrounding yourself with a community that can fuel you up when you need it.
I wonder, when you started your fund, I guess like how do you think about like I guess like number one is like, since like you have such a successful career in finance, I'm sure like all of these like fintech startup would be like, hey, like can you be on our board or something, like, or can you invest in us? Number one, like what is like the, I guess, what is like a overall the portfolio construction look like? Would you say like you're like more focusing on like the high concentration vibe things, or like do you feel like it's more supposed to be like a more index approach? And
Yeah.
when you're choosing these like a million fintech company that comes to you, what is your like diligencing and picking process look like?
Yeah, that's a big question. Okay, well, let's start with our thesis because when my partner Sean and I started Anthemis, it was circa 2008, which feels like eons ago now. And at the time, we were both working at large financial institutions. We had for our sins portfolio of
Mhm.
all of the technology investments that the banks that we were working at had that frankly didn't know what they were didn't know what to do with them. And we met one another and we started talking about what we saw as a massive disruption that folks hadn't really appreciated yet. And it feels pretty simple now to say it's this, right?
Mhm. Mhm.
This sort of smartphone, the supercomputer in our pocket that launched in 2008 for financial services was a game changer. And we saw very early that there were signs that that everything would be upended. And I think because we shared a value system around that thesis, right, that we could
Mhm.
deploy capital in order to transform and transition the financial system to for the digital age, but you could do it for good or you could do it for
Mhm.
evil, right? And so I think starting first and foremost, you've got to have a strong thesis, a thesis that sort of for us, you know, has been the same since 2008 as it is now. We take different, you know, we there have been different cycles of that thesis, but for the most part, our job is to deploy human, intellectual, and financial capital in the service of reinventing a fundamentally broken financial system. And if we do our job properly, we will make financial services or be part of making financial services ubiquitous to the economy. No one should see it. It should be the healthiest, most resilient, most accessible, most transparent line again underneath supporting our entire economy, but no one should see it. And that's our thesis. And so for me, when it's, you know, starting, whether it's us starting a fund or anybody, I would say, you know, just having an idea that you want to be a VC investor isn't enough, not in this day and
Mhm.
age. You have to have a thesis. You have to be able to prove what that thesis looks like by a series of investments, early investments. And for us, that was putting our money behind things like Zoopla and Climate Corp and Betterment, which were sort of early indications of what we saw the financial services industry doing and doing right. And then from there, I've always thought it really important to have, as an investor, a set of values and principles that guide you. For us, it was about, you know, transforming financial services is not really supposed to be a revolution. It is, and by default, because of the complexity of our system, in evolution. And so we knew from day one we would be working in collaboration and in concert with a much wider ecosystem of incumbents and regulators and academics and researchers, all sort of around and interested in the same thing. And I think that guided us early days because it meant that we weren't looking to just, you know, throw some capital over here and blow up this industry or blow up that theme. It was more about finding the problems within the industry and figuring out how we might be able to support and attack those challenges from outside, right? So being insiders, working with the industry, but provoking from the outside through new investments. And then I think from there it was, you know, this immediate desire to do more good, not even more good. And you know, we went in with a goal of deploying capital that would leave the world net positive better than we found it. And so that stopped us from doing a handful of things over the years that I think might have been easy ways to make capital, but not necessarily best for humanity, right? And so we steered clear of a lot of the predatory lending platforms early on. Some of the payment systems were a little bit off from a values and a thesis perspective. And then thirdly, our commitment to diversity, inclusivity, and equity in everything we do, I think has shaped a lot of how we deploy capital, right? So when we talk about $1 billion plus under management at work in this, in service of our thesis, we're also recognizing that 50% of that is in the hands of women and people of color. And that's in an industry that people will argue doesn't allow for that. There is no pipeline, right? And so, you know, having those guiding principles early has really shaped the portfolio, and I think, you know, will continue to do so for a very long time.
Totally. I have a quick question about like so when I think like I heard about this on like another podcast you went on, you talk about like your partner Sean would publish some like industry insights or something, and then you would like be faster executor than him.
Yeah.
So what were the things that he was publishing that you like? What would the
Oh, well,
execution look like for
I
you
mean,
again?
yeah, I mean, so the story goes that when Sean and I first met, he'd sort of referred to me as his Newman, from the Seinfeld analogy, and it was because he had these, he had all these big ideas and these wonderful ideas, and he was um, just starting to get them started. And then I would come in at Barclays, where I was at the time, and execute them just quicker or faster than him. And
Mhm,
when we met, I said, Sean, I've been reading your blog for a really long time.
mhm,
And this was back in the days when blogs were written. And I don't know how many people were, but actually in the last few years, we've met people that have been reading that blog. And it's funny because there's like a very small community of us, but it was pretty brilliant stuff. I mean, in the earliest days, it was, sadly, not sadly, in a good way, what Sean was saying in 2006, 2007, 2008 is exactly what the world is starting to finally say today, right? Which is that we need a strong financial system in order for our economy to achieve its maximum value, not from an economic perspective solely, but from a humanitarian perspective. But the importance of financial services is sort of like the financial services layer is to our economy what the internet is to
mhm,
the entire world, right? And so we need the ubiquity of this safe, secure, transparent, supportive, resilient layer, but we need it
mhm,
to be existing across the entire economy, and we need it to disappear to make it easier
mhm,
for things to grow off of it. And in the earliest days, we used to talk about, and this is even before fintech was a thing. We
mhm,
would push really hard against people who would say, "Oh, you're doing fintech." And we'd say, "No, it isn't fintech, right? Like, there's no such thing as fintech. We're talking about just digitizing the entire financial layer, period.
mhm,
And that's not fintech." But then we got kind of tired, and everybody kept saying fintech, so we just leaned in with the fintech.
mhm,
But
mhm,
lately, in the last, like, literally the last 3-6 months, so many people have said to me, "Oh, it's actually not fintech, is it? It's fintech is everything, isn't it? Isn't like, where is financial services
mhm.
not relevant to what we're doing inside of business and in our system?" And now it's starting to, so as much as it feels like it was, you know it's like the same old, he was very prescient about seeing this in a very, very early time, and it was, literally as this was being dropped.
Totally. I wonder, so like, um, in terms of like building a successful fund. Well, let's talk about like the investing side of things first. I like obviously you mentioned about like you guys tap into like the right trend, which is like the smartphone revolution of like building everything based off like this new technology or like this new hardware that kind of like shape how human interact with
Yeah.
fintech. But anyway, so I wonder when you are thinking about today's age, like I would argue like that would be like AI, right? Like so or maybe
Hmm.
like I guess like will there be like a hardware like in the AI space that just like transform
Hmm.
like how we live than the iPhone? Or like do you think there will be like a hardware revolution there? So
Hmm.
like it will shape how people interact with the financial side of things? Or do you feel like it's more of like AI in general will just
Yeah,
like
I
help?
mean, yeah, we can talk about AI in a second, and I can share some early views on that. But I think, when I talk about the hardware mechanism of the iPhone, I guess what I'm saying is it kick-started an industry, in our case, the financial services, technology, investing industry, um, in a way that was quick and supercharged and sort of required kind of round one of fintech to take hold, which was really the um, interface, changing the interface of how people interact with their financial system, right? So this is when things like the robo advisors and all the kind of front end thing, that was kind of phase one. Phase two, which I would say was probably 2015 to 2020, was in large part what has now become known fairly ubiquitously as embedded finance, right? The idea that you could have a financial services company or infrastructure that is embedded into an industry that then enables a handful of other economic industries to grow. And what we're talking about now is this idea that finance essentially becomes invisible, and what you're investing in as a fintech investor, as a financial service
Mhm,
investor, is the underlying business that is serviced by financial services, right? So what I think it does and changes for investors like us is that when you look at, say, what's a good example? Like, well, I mean, like the way we're looking at climate tech right now, right? The assumption is that climate tech, um, as a generalist category, will require, so much of the funding in the last couple of years has been to climate tech funds. This sort of generalist idea, I think, is going to land people who invest in these climate tech fund generalists in the space where they're just getting the same trades, right? Whereas I think the way to invest in climate tech is to find an industry expert and then invest in their thesis within climate, right? Because the climate transition will be underlined by a massive transition in financial services, right? And so what are the climate elements of that financial services enables in the climate transition, and invest in that, right? Or, we've seen it in healthcare, the way the industry now, we look at a healthcare investment or a healthcare company, it's in large part this insurance and risk piece is embedded into the model, and you're offering healthcare and enabling healthcare for employees or for underinsured, but it's not a fintech company, right? It's a XYZ company where the financial services is underlying. I think so do I think there's a new hardware that's going to come up in anything? AI is going to change our world. It's going to change our lives. I think it will be as impactful to our world as the internet has been. So I think we're talking like that level of existential change. But I think it's still very early. And I do think that the stuff that we're investing in right now, and that I think that seems investable, is in large part around process and efficiency, right? And so finding ways to use various different AI models to improve X, Y, and Z in the legal stack or in the insurance stack. That's the stuff that feels investable right now. The long-term impact of AI, I think, it's really too soon to tell. But I will tell you, as an early stage investor, it's one of the reasons why we pay so much attention in our due diligence process to founders, right? Because when you're talking about the capacity to build something that has that much power and that much potential control, whose hands it's in matters. And I think founder risk in the early stages is about the most important thing you can have for any company. But when it comes to AI, I think we have to spend a little extra time due diligencing people.
I want to just double click on a few parts in what you just mentioned. So one is I have a fascination about why climate tech is making a comeback, just because I've heard obviously I feel I know a lot of emerging managers who are trying to start climate related funds or deep tech related funds. I've heard mixed things about people fundraising from the LP community. What number one is what is a major trends that kind of giving climate a second chance? Because in the past, people were I heard, this was before I entered the scene of venture, but I've heard 10 years ago there was a climate revolution that was kind of a failure in the venture community, and I wonder nowadays why there's a major shift towards climate.
Yeah, I don't know that it's. I mean, I'll attack the sort of funds and the investment theses a little bit differently than sort of your assertion that there was a failure. I think the challenge has been in the way that we have governed and managed and monitored ESG and impact funds, right? And I think there was a really that has taken a real beating in the last couple of years. Redemptions kind of galore and people closing up shop, and I think that has, because it was such a narrowly defined way to look at impact, right? It really became a check the box exercise. So a fund like ours, for example, we believe that our job is to do maximum positive impact on the world, but we would not call ourselves an impact fund, nor would we probably get any credit for ESG, right? Because we're not shoving ourselves into a certain box. We're just trying to deploy capital in a way that makes things better everywhere. And there's no category for that. We're also not, always with lots of other similar minded folks. But so I do think that there's been a backlash against kind of, a fund that is trying to manage and monitor themselves as ESG or impact. I think where the opportunities still lie and will continue to lie, and this is not going away, is that climate transition, energy transition is going to impact every industry in the world forever, right? At least for the next 30 years. And I think that finding the funds and the investors who have a specific thesis about how their knowledge, their expertise, their ecosystem will positively impact this process and this energy transition is the way to go, right? So there are tons of folks, and I would say the last 6 months is a lot more. I bet my worry is that there's too many generalists, right? That this kind of idea that we're climate tech, it's just the same thing with blockchain, it's the same thing with crypto, it's the same thing with AI. Like we used to have I think we changed it now to AI, but in our website, when you put in an idea that you want us to take a look at, we say in the if your idea is basically an AI company, please don't tell us that you're an AI company. Tell us what you plan to do, right? What is the business model? What is the problem you're trying to solve? Not, I'm an AI company, so invest in me, right? I'm a crypto company, invest in me. And there's a little bit of that around climate tech, but I think there are a lot of industry fund expertise in sort of the not generalist, but in the very expertise, sort of industry sectorial focused investors that are actually doing some really cool things in the climate space. So I think you're going to continue to see more of that. It's going to be about, in our space for financial services, it's about how do we support, we've got a company called Agrina that's doing amazing work. They're out of Copenhagen, and they're essentially helping farmers transition to regenerative agriculture, knowing the positive impact that will have in the world, but they need a mechanism through carbon credits and through financing to be able to figure out how to do that, right? Same thing with a company we have called KWH Analytics, where they're helping finance the shift to solar energy, right? So it's not a solar company per se, but it's a financial services layer that supports the transition.
I wonder, so like since like you have invested in like some really great deals like eToro or Carta or like some like other fintech brands that's like famous, I wonder when it comes to like picking what to invest in, like what would be your thinking framework on diligencing the company, and what would be like the indicators that you feel like something would
well, I think it starts with sort of the top of the pipeline. Like, how do you get the best ideas into the company so that you can then decide if you're going to dig further? And I think for us, the answer has always been that we have a wide and diverse group of investors working all over the world in a way that is different than a lot of our competitors. And so, our team alone, like 65% of our investment team are female. Like that doesn't happen very often in VC, and it most certainly doesn't happen in financial services VC. And so you can imagine 30% of the company are people of color. Like you can imagine that the ponds that we're swimming in are very different. And so we're getting really like uncorrelated, like we're getting deals that other people aren't seeing, right? And that happens for us all the time. Or we're getting, because of our deep understanding of the financial services layer, we're getting really good deal flow from people in other industries who think we could add value to the trade because they understand their industry, but they don't understand as much how maybe the financial layer works, right? So that's kind of the key, is to get the most deal flow in. It helps as well that Sean and I have been around for so long, right? So we have a lot of brand and reputational value that I think we use in service of some of the stuff that we're getting. And our team is, we have a kind of one team model. So if you get a deal, for example, we just had recently somebody got a deal out of Germany because they live in London. They were in this German community, and it was too early stage for what they were doing. And so they handed off to one of the different funds. We have 3 strategies. We have our venture studio, which is solely investing in female innovators, our early stage strategy, and our venture growth strategy. So there's a lot of deal showing in that. But once we get it through the pipeline, it's really a very collaborative and cohesive kind of team experience where we look to, it's all, first it has to match the thesis, and not just the thesis, but the thesis of what we're looking at in that moment, right? So we're looking at things differently now than we did 3 years ago and 6 years ago. And then we go from there. The due diligence process, I think, again, at early stage investor, the requirement to due diligence human beings is very, very high. This, you're not looking at a at a company that has a massive trajectory for how they're going to make money. If they have great ideas and they have a really good sense that they've got the problem, that they know what problem they want to solve, and that market is big enough for it to be a venture-backed investment. But beyond that, we have to expect that company is likely to pivot 1, maybe 2 times before they get it right. And often our companies have done that. and I think so sort of finding that way to be able to establish the relationship really early, to be able to test and work with that founder, and check their resilience. I mean, that's this last couple of years, that's been I think a really important element that is kind of hard to measure, right? Like, how resilient is a founder when things get really tough, when when Silicon Valley Bank
Mhm.
disappears tomorrow. What are you going to do? And I think that just generationally, this generation of entrepreneurs largely, and this generation of venture capitalists largely, have never worked through a downturn market. And
Mhm.
so we saw what happened when the market all of a sudden didn't go up. And
Mhm.
I think a lot of people panicked. And I think a lot of the behavior you saw in the last couple of years had a lot to do with that panic. And sadly, some good companies got lost in the shuffle of that panic. But I think that sort of, we're testing more and more this conversation of how do you check for resiliency when things get rough? What happens?
I wonder, so like you mentioned about like you guys have like a venture studio that's primarily backed like the female led founders.
Yeah.
And I wonder like, so for the fund internally, I guess like how do you categorize like your team? Like how do you like allocate your resources towards like either like sourcing better deals or like building out like a program that's like helping
Yeah.
portfolio succeed?
Well, because we have those three phases, the nice thing about it is that it often gives us a chance. We all need to be looking at the trades on the entire portfolio, because those trades might actually be companies you want to back in your strategy later. So we have a pretty collaborative approach. I mean, we have, your typical weekly investment team meeting, and then we have individual teams with three different teams that are focused on the three different strategies. But the three leaders of those team work weekly together on our IC. They're seeing everything that we're deploying capital against, and they're getting a chance to observe and ask questions on every strategy. So it happens pretty organically. I mean, I think, again, you know, one of the things we've been toying with recently is this idea that we're making a couple hires right now. Actually, flag out for that if anybody is a senior analyst or a junior associate in New York and is looking for a job. Please pay attention to our LinkedIn. It'll be coming soon, and you can apply there. Please don't apply to me because I won't I won't be able to help you. But when we're bringing in analysts and associates, and we're thinking a lot about how do we encourage that one team approach. And so what we've been thinking about lately is that with the new talent we're bringing in is enabling them to sort of be across multiple funds, which is a unique opportunity because of the size of our firm. And we're not just, so you're getting the earliest venture studio experience, but you also then can have exposure to venture growth, which is great because you can watch a company go from start to finish as far as Anthemis is concerned.
I wonder, as you mentioned, like the person will be working towards like multiple funds. I wonder, what does working with multiple funds look like? I know like some of them are like later on in their career in terms of like the company's growth, and like yesterday we had an investor came on, shared the experience of like joining a bigger fund as an associate. Like the first day it was assigned to a lot of board seats. I wonder what does it look like to work across multiple funds, and
Yeah.
how do you manage your time when it comes to like, fundraising for new funds, and as well
Yeah.
as like obviously this is like not for, this is only for information and entertainment
Yeah.
purposes, and like for educational purposes, not
Yeah.
like financial advice.
No,
Just
it's
want to put it out
a great question. I mean, look, it's most of what we're doing is deploying across early stage. So even at venture growth, we're usually going in around B, maybe C.
there. Mhm.
So we're still talking about fairly early stage investing, right? So the skill sets or the experience is not radically different across the stages. But I will say, and that it's changing a little bit now, but when we first started the Female Innovators Lab, um, we earnestly wanted women who were still working in their jobs, who had an idea and weren't sure if it was investable, right? That's the earliest kernel of idea. And what it takes to help support an entrepreneur that is just getting started, hasn't made their first hire yet, doesn't even have a pro forma go to market business plan for that matter.
Mhm.
Um, that's a very different, it's a much more collaborative experience than I think as you get a little further on. When we're in the early stage phase, we're leading deals. So we are getting board seats. We often take an observer seat as well. And we do that deliberately. Part of it's because our reputation sort of enables us to get both the board seat and the observer seat. And we'll use the observer seats to train people that haven't sat on board yet. So we'll float our juniors around all the different boards and the different observer seats so they can get to see what it is that being a board member looks like. So that as over time, as they grow and they get promoted, they can benefit from that experience. And then venture growth, I think it's the same. Our venture growth strategy is not leading deals, and so oftentimes we don't have board seats there. So there, it's more about the relationships you're building with other VCs, making sure that you're networked in various different communities. So it's a little bit different, kind of from. But I would hope that anybody at Anthemis that's gone through the ringer will be equally capable of doing all of those things. It's just a matter of what you spend most of your time doing in any given moment, if that makes sense.
Totally. I wonder when it comes to like thinking about like investing strategies. I know that like you mentioned about like the venture studio on the earlier end. So I guess like that's a great way to like kind of also monitor the growth of a
Yeah.
company. I wonder like in terms of like running a successful fund, like how do you think about like investing in like full on runs, or like how do you think about in general like um exiting of like certain portfolio companies? If there's like any like thinking framework, maybe we could use like an successful
Yeah.
example from the past.
Yeah. I mean, look, when you invest at the early stage and you're one of the original, sort of one of the first institutional money on a cap table,
Mhm.
you and our funds are set up with a sort of 10 plus time frame. Like your expectation is it will take some time to grow this company to a place where you can exit. From time to time, and this has happened a few times to us, which has been a good thing, you'll have a company that is, I'll take one example of a company that we had called Power that was, extraordinary founding team, extraordinary business model, right time, right place, and made a decision, a conscious decision to be very stealth. I don't think they actually launched the business. They did a lot of the sort of background stuff before even their A. I want to say that I think that they didn't launch the business till their A. And then when they did, they had an immediate amount of attention on them. And so there was potential acquisition coming in really quickly. And I remember talking to the founder, and he was being very, very earnest and just sort of blatantly asked, like, I know we can build this into a $1 billion company. Now I think this was like winter of 2021, right? So it's like he was sort of sitting there going, I know we can build this into winter of 2022. So imagine winter of 2022. I know we can build this into a $1 billion company, but I don't know if we can do that right now, given where the market was. And so we talked through it, and I completely agreed with him. And sometimes you just have to take a chance. They had an acquisition offer come in, and it was a great offer, and so we went down that journey instead. And I think you don't always know when the opportunity is going to come, and again, these markets move pretty quickly. But I think you've got to go in knowing that you've got 10 years to return the fund, then some. But it's nice when you've got some early, that was our fund, that was in our fund too. So it was a really nice time to sort of get, and it was a 2020 vintage. So it was kind of nice to have an exit that early on.
Totally. I wonder, so like I want to circle back on the AI topic. So since you mentioned like, there are only a certain things that you would pay attention to, like for example, let's say like, I guess, like, what would you not look at in the AI companies that, like, for example, there's a lot of, like, AI company that's in in the fintech space. What would be the quick filter for you that, like, certain things just, like, will not work?
Well, I mean, the quickest filter goes down to what I said earlier about backing, founder risk.
Mhm,
If we didn't feel aligned in values with the founder of any AI company, or any company for that matter, we would say no, which might mean we would pass on something that could be extraordinarily economically, successful. But what we found in the last 15 plus years that we've been doing this is that the companies that we passed on in 2010, 2012, 2014, that did go on to have some extraordinary outcomes for a moment, were also the same companies that when things got ugly, they fell apart, right? And so while we were defending ourselves for not investing in certain things because of a founder risk or a concern about a business model or a predatory nature of the business model, we had to defend ourselves from like 2015 to 2018. We were defending ourselves a lot, and then all of a sudden it turned around with like, oh, that was a good miss, right? So those are the types of things that I think, to me, and it's hard to say. We're early stage investors, so founder risk is kind of everything in that capacity. I think with AI, the way I've been thinking about it, and this is true to the Anthemis thesis generally, as technology investors, it's almost like it was our job, right? We were given a card as soon as you decide you're going to be a technology investor that says your job is to take all friction out of every part of the world ever. And I don't know that that's exactly the right thing to optimize for. And I think that a lot of these AI models are trying to do exactly that. And I think you have to find that sort of happy medium where you can insert some friction back in so that we can actually check ourselves and continue to be human, right? I mean, this is probably a silly example, but like Uber is a perfect example as far as I'm concerned, right? Like it was a fintech company in so much that it revolutionized payments. But now we've got a situation where the large majority of us are getting into cars, having somebody else behind the wheel that we don't know, which is fine. That's taxis, but we're getting in and there's a button that says, don't talk to me. Like you're taking, like we're literally allowing ourselves to put ourselves in a contract with somebody who could literally drive you into a wall. And you want so little friction that you are willing to push a button that says, don't play your music, don't talk to me. That scares me. I think it scares me not as a tech investor, but as a human. And I think we need to, so when I look at AI, it's like, how do we find ways to use the new technology in support of efficiency, in support of effectiveness, but without replacing humanity?
Wow, that's such a deep topic that I feel like I'm so unqualified to talk about.
Very friction
But
forward concept, right? This
uh,
idea is like, don't take all the friction out.
I wonder when it comes to like, fundraising for a fund, I guess like what like is there any like particular like tips that you could give to
No.
like younger investors as like, obviously you have like you had successfully raised like funds in the past, and I wonder what does the journey look like from identifying like anchor
Yeah.
LPs to like, getting
Yeah.
like other people to like close on
Yeah.
investing in the fund?
I think probably two pieces of advice. One would be that it's really hard for everybody, right? I think a lot of folks can get really exasperated thinking that I don't understand. What have I done wrong? Like getting that many no's, you have to get a lot of no's before you get a yes, right? So there's that element of it. I mean, it's still very hard for us, and we've got great performing funds with massive track record. Like it is a really hard thing that our industry, I think, could make a little bit less hard, but it hasn't yet. And so here's where we are. But one of the ways for me that that gets it slightly easier is that, and I think you couldn't do this over the last few years because of the way the markets were working, but now they've slowed down to the level where I think it's it's a fair approach, and it's certainly getting me through the day. I think all of us got very transactional with our fundraising, right? This idea that you could meet somebody in an hour, pitch them your fund, they give you your money the next day, and within 2 weeks you're off and running. Like that did happen sometimes, and probably wrongly, but you're asking somebody to partner with you for 10 years. Take a little bit more time to focus on the people you think you will be aligned with and spend time getting to know one another. Like people that allocate capital are putting the responsibility of you for delivering the returns that is their job, right? And that's not an easy decision. And so I think, it got transactional for a reason, but I don't think that's what's been good for us. I think so recognizing that it does take a little bit more time to build relationships. And I think those relationships long-term will be much more productive. But also it helps if you're going to build, like this is 10 years, like you have to tolerate me for 10 years. You have to like me for 10. Well, I mean, I have to like me, but you have to play with me for 10 years. But I also have to play with you, right? And so to sort of make it a little bit less transactional and make it a little bit more relationship built, I think will serve us all incredibly well.
let's say after, like, I feel like most funds are deployed after, like, unless you have like a giant size fund, like most earlier stage managers like are dealing with like a small fund, and that's like,
Right.
you could be invest up to like call it 2 years.
Yeah.
After the 2 years of like you deploying that, not you, like generally the fund manager deploy the capital after the first 2 years. What does the process look like moving forward
Yeah.
with the fund? Obviously people are start raising the second, third fund after like a year or so. Like
Yeah.
how, I guess, like what does the management process look like
Yeah.
after like two
Well,
years you deploy the
the,
fund?
the perfect version of it is that you take 2.5 years, 3 years to deploy the fund, and you have had yourself or your team focusing on managing the relationship with LPs, that they are aware that you will be going back for fund 2, 3, 4, 5, and that
Mhm.
again, non-transactional. Don't talk to them at the beginning of fund one, and then 3 years later go back to them and say, "Hey, great, we're done here. Can you give it to," like, that's not going to work. So finding a way to kind of create a smart investor communications, investor relations, investor connection program, so that the the re-up, the next fund is easier. That said, it's really tricky, right? Because you could spend all of your time building a great relationship with somebody, and they could turn around tomorrow and go someplace else, and then the new team at that firm decides, "Oh, we're not going to re-up with you. We don't know you." So there's a bit of a risk in all of this. But I think that what happens from a fund management perspective is it's kind of like that's where it gets good, right? You've made your bets, you put your money on the table, and you are fundamentally now responsible for helping build these businesses. And I think a lot of venture investors, particularly in the last cycle, the ones that got into trouble were the ones that weren't interested in helping build businesses. They were just interested in playing a game that everybody else seemed to be playing and winning at, right? And so you have these people that were not industry experts in our case, right, in financial services. They were not industry experts. They were not venture investors. They were barely even early stage investors. Like they're coming in and they're blowing up all these companies. And you know what? I keep saying this thing that seems to be resonating, that two things have to happen at the same time to have what happened in the last couple of years happen. One is that you have a bunch of people that don't know what they're doing, throwing a ton of money at the wrong valuation at a bunch of companies. And two, those companies have to believe they're worth that, right? And if those two things happen together at the same time, that's where you have disaster. And so some of the wins that I really liked over the last few years for Anthemis was how when we won deals against people who were valuing the company higher, but their desire to work with us allowed them and enabled them to think, you know what, we'll take a little bit of a haircut on this seed round, and let's prove ourselves. And those are the companies that I think have a much better chance to survive, because the job of an investor is not just to deploy capital in a round; it's to help work with those founders and that company to help them establish a track record and build their businesses going forward. And so the real work for us is not just making the first investment, but it's about being on the board, being an effective board manager, using our huge ecosystem of banks and financial services companies and insurance companies to bear fruit for some of these portfolio companies, right? Whether that's strategic alliances, in some cases M&A, but in all cases, sort of connectivity. But that's the job of an investor. It's hard work. It's not just throwing a dart at a bullseye and hoping it sticks.
When it comes to the valuation, like obviously, like I feel like now I guess like we're having a little bit like more normal valuation
Yeah.
versus like, like I got, I guess, like 2 years ago or something. And I wonder like what would be like a good like valuation on valuation? Like what
Mhm.
is a valuation that makes sense?
Well, I think it depends. I mean, it depends on the stage. It depends on the company, right? Per se. I think we're seeing a lot fewer runaway trades, right? The trades that sort of come with these ridiculous valuations, and then say, "Oh, they're going to be gone tomorrow if you miss them." And in some cases, it's probably better to have missed them. But I think we're back to, the same. Trying to think, maybe like some people say like 2013, 2014. I think it's probably like 15, 16, 17. Like that feels about where we are, and I think that's still maybe a little. I mean, is there still room for some of these valuations to come down? Again, I think it depends on the founder, but the stuff that we're looking at now, and we're just we're deploying in one fund, we're getting back in the market in another. Um, it definitely feels decidedly different this year than it did last year at this time. Much more rational behavior in founders, a radically different cadence. And I think that's been helpful. So we have time to do the due diligence and the thinking on these trades that we maybe all rushed through in the last couple of years. But it's definitely, yeah, I mean, it's not, there's some extraordinary valuable companies coming out of this cycle. And as anybody who's ever invested in venture knows, this sort of 2024 vintage, even 2025 vintage is going to be pretty spectacular because that's the bottom of the market.
I wonder, so like when it comes to like working with like I guess like when it comes to fundraising, uh like what would be the things that like for example, like I feel like there will be people that are um saying yes, but like in the end it was a no kind of things. Or I guess like how do you number one is like what would be like the normal amount of rejection that you have to get through to like get to a yes? And like how like I guess like everyone is saying it's hard. Like what exactly is the hardest part? Is it like dealing with so much no towards like
Mm,
as a founder of a fund, like personally, like you're just like feeling not you, but like the
yeah,
person will feel like frustrated, or would it be more of like um I guess what would be the hardest part among the rejection or like I
yeah,
guess like what does a sales process even look like as after all this is an enterprise sales
yeah,
job. And I wonder like what it like when people say like what exactly I guess like there will be people that are saying yes but or like giving you great feedback but like didn't end up investing,
yeah,
or the people who are investing but like didn't really like give you like a positive like feedback at the beginning. Like I guess like what does the process kind of like look like for
yeah,
a seasoned matured investor
yeah.
like who has like been through like all these.
Who's a woman? Let's not pretend that isn't a
Yeah,
determinant
yeah,
in
yeah,
this
yeah,
conversation.
100%. Yeah, yeah,
Yeah,
like
look, it's it can be at times frustrating. It can be times exhausting. Every now and then you'll meet, and again, this is where I think the relationship building, you'll meet an LP that you completely align with in terms of you just like them, right? You just like each
mhm.
other. Um, and you can tell the difference between an LP who really wants to do the deal but is kind of stuck in their own process, and one that's just sort of like giving you like lip service and they were never going to invest. I think I've just gotten really good at this. I mean, not by anything other than just I've just done it a lot. Um, and by the way, I'm no better at trying to close capital faster. That just doesn't happen. But I think that the challenge and the opportunity, right, is as a fund manager, kind of knowing when someone isn't speaking your language, right? And so that for me is, a lot of times we'll talk about like, okay, should other people go on the first pitch, and or should Amy go on the first pitch? And I actually quite like going on the first pitch because I can tell in that first pitch if this organization is that real interested in doing something different, right? And we are a different trade. We are professing to generate alpha because we do things differently. And there are a lot of people that don't want different. They want same old, same old, same old. They want the Valley investor that's done it 15 times and that doesn't take any risk and, hope for the best that they'll keep hiring good associates and churning them through, and that's what they get. We're not that firm. And so for me, it's about, making that connection early on and getting a sense of whether or not this is worth a conversation. But in terms of the process, I mean, like the number one thing that I think, and I give this advice, but I do not take it myself, is to try not to take it personally. It's really hard to be told no over and over and over and over and over and over and over again, particularly when you're putting, I don't tend to pitch without passion, right? I really believe in what we're doing, and I really believe that if we moved money in the right direction, things would make a difference. Um, but you can get exasperated, right? But if you take it personally, then it'll wear you down pretty quickly. So try not to take it personally, and to know that a lot of these folks, they very well might want to do what you're asking them to do, but they've got their own process. It depends. So when you asked about the process, so institutional investors have a very long process. I don't think you could expect to get into a cycle with an institutional investor or like a big consultant without committing at least 8 months, maybe even 12 as a minimum.
Mhm.
So a lot of these, you start the conversation in 2024 so that you can get on their radar screen for 2025, and then you start the conversations in 2025 about the actual fund. So you have to really be. That's a lot of preparing, right? I think for us, we have a lot of strategic support because of the nature of our industry. So a lot of LPs that have backed us and have been CVCs and banks and insurance company, and those have been great partners because as much as we're supporting and serving them when with workshops or with different sessions to try to kind of learn together, we're also gaining information that we're feeding into our thesis, right? Because we're hearing the problems that they're trying to solve and are struggling with. And so we can use that to sort of chart out where in the early stages in XYZ industry that might be useful. So those are, they don't take, they can take about 6 months, I would think, sometimes, depends on kind of the organization. Family offices tend to be a little bit more nimble, and they can move a little quicker. But again, I think if you're a family office and you don't actually like or believe in the investment team that you're backing, then you should not be investing in them, right? Because your job as a family office is to generate wealth long-term and legacy protection and wealth protection, right? And so if you're talking about making a 10-year commitment to somebody, you better be aligned from a values perspective.
Um, I wanna, like, learn more about, like, as a female investor,
Mhm.
I feel like you have to, like, I really like what you said early on about, like, you don't want to be the baby analyst somewhere, like, you don't wanna go through, like, the traditional path,
Mhm.
but you're, like, so, like, very successful today. I wonder what would be, like, your, like, thinking framework to unblock yourself
Mm.
from, like, achieving something that haven't been, like, done by, like, other people, before, and then, like, what would be, like, I guess, like, at one point you raised, like, a $700 million fund, and, like, I wonder, like, for, like, as a, like, a younger female, like, when I look at your success, I feel like one question I would ask myself is, like, what is, like, a good benchmark to benchmark myself off? Like,
Mm.
as a, there's a lot of, like, male, um, investors in the world, and I guess, like, I don't really know, like, what would be, like, the best benchmark to be like,
Yeah.
"Okay, we should push the boundary here," like, to challenge ourselves in a certain way, or, like, there is just, like, a hard limit as, like, a woman that, like, somewhere have to just, like, stop. Like, I wonder
Yeah.
how do you.
I mean, look, I don't think we, as women, I don't think we should ever accept that there's a limit, right? I think you have to accept that it's going to be harder for you. And anybody that says differently is, I, congratulations. Like, our system, this world that we live in was not built for us. It was not built for women. It was
Mhm.
not built for people of color. So it doesn't work for us. And that can be extraordinarily frustrating. And I think partly why I found my way, I think the piece of advice I gave earlier is that sort of find something that nobody else is doing because it will allow you to stand out for something other than your gender or the color of your skin. And that was my biggest excitement, but also fear about all of the exciting language around backing female founders, backing female fund managers, backing women, backing people of color in the last couple of years, was that it was going to be a big marketing campaign and virtue signaling, and that we're all wondering where all that money went, because I've been doing this now for almost 20 years as an investor trying to raise capital, and we were very well supported by Barclays, Aviva, and Visa to help launch our and BMO to help launch our Female Innovators Lab. But I have never received one check in my life because I am a female GP. And so the idea that all these billions of dollars was supposed to be going to different, nobody knows where it went, if it went anywhere. And so that can be really, really frustrating. I don't have any advice really as to sort of how you keep getting up out of bed in the morning and keep going for it. I do, kind of go back to what I said at the beginning. It's about finding a community that you can trust and that you can be vulnerable with so that you can actually continue to do the hard work. I'm very, very conscious of, and it's partly because I'm getting older now. I had a dinner a couple weeks ago with Sally Krawcheck, who I have a lot of respect for, and Sally is one of the OGs in the
Mhm.
services world, and we were talking about kind of that experience, and it's really easy in my generation, because Sally was a little bit before me, to feel like, oh well, they're not helping me, and so therefore I've got to do it all myself. Well, that was a very different generation. And what we've learned in that, like all of us learned in that generation, is that our job should be to help everybody because we need more help, right? And so now what I worry a little bit about is how generations of women, it's just natural, the generation shift. Like, I want to respect and honor the people that came before me because I know I stand on their shoulders. And I think that whenever we're sort of working in the kind of world of equity for women, we need to all respect and appreciate the shoulders that we stand on, because this is a fight, and it's one that's not going to be quickly won. There's a lot of work to reinvent a system that works for us and that invites us in, and that is fair to us. But the only way to keep doing it is to make sure you've got people around you that you can rely on, trust, be vulnerable around, and know that they've got your back.
Totally. On that note, I have a 1-minute fire round for you before we end.
Yeah.
What's your favorite book?
Oh, probably Joan Didion's The Year of Magical Thinking.
Who made the biggest impact in your career?
Probably Tom Collaris at Barclays.
Who would you invite to your dinner party?
Are they alive or dead?
It's your party.
That's a great question. Probably Gloria Steinem.
Where can we find you outside of work?
At a yoga studio with my children, or reading.
Yoga studio with your children?
No, not with my children. They're two separate.
Okay. I'm like, wow, that's a family yoga time.
Yeah, yoga studio with my children or reading.
Amazing. Thank you so much, Amy, for coming on the show. You're so fun to chat with.
Oh, thanks, Grace. I really appreciate you having me.